right now, as you listen to this, your bank account shows a balance. Let's say it's, I don't know, $5,000.
Right, a typical checking account.
Yeah. You look at that screen on your phone and you just naturally believe that money is sitting there waiting for you. Like it is your property.
Of course. That's the baseline assumption we all have.
But what if I told you that legally and mathematically, two completely different people own the exclusive right to spend those exact same dollars at this very second?
I mean, it sounds like a glitch in the matrix. It's an absolute impossibility.
Right. Two physical objects cannot occupy the same space. Yet that impossible contradiction is the beating heart of the global financial system.
It really is.
So today, we are undertaking a massive mission for you, the listener. We are unpacking a truly monumental treatise called Money, Bank Credit, and Economic Cycles.
Yeah, and it is an absolute powerhouse of a book. It's written by Jesús Huerta de Soto, who is a leading Spanish economist of the Austrian School of Economics.
And our goal today isn't just to, talk about abstract economic theory. The ambition here is to completely revolutionize how you view money.
Exactly. How you view checking accounts and, those chaotic financial headlines you read every single day.
Because Huerta de Soto combines ancient legal history, moral philosophy, economic theory, and the granular practice of banking to explain the true root causes of economic chaos.
Yeah, we're going to build a massive framework to show exactly why financial panics keep repeating, why market crashes, inflation, and massive credit booms feel like this repeating loop in human history.
And most importantly, we are going to examine the central banks, the institutions that always seem to rush in to put out the economic fires.
Right, we're going to explore the terrifying possibility that the firefighters might actually be the arsonists.
Okay, let's unpack this. Because to understand the financial panics of today, we can't start by looking at Wall Street or the Federal Reserve. We actually have to travel all the way back to antiquity.
Way back. We have to start with Roman law.
Which is where the entire foundation of Huerta de Soto's argument rests.
Right. He argues that modern banking is built upon this fundamental historical corruption of legal property rights.
So to see this, we have to understand the rigid distinction ancient jurists made between two very specific types of contracts.
Yeah, the monetary loan contract and the monetary irregular deposit.
Today, people conflate these two completely, right? Like we treat them as the exact same thing.
We do. But classically, mixing them up was considered a severe crime.
Let's lay out the architecture of those two contracts, starting with the loan.
Okay, so in Roman legal terms, this is known as a mutuum.
A mutuum, right. So if I enter into a mutuum with you, I am voluntarily transferring the ownership of a specific quantity of my present money over to you for a defined set period of time.
Exactly. So if you lend me $10,000 for a year, you are constantly surrendering the availability of that money.
Yeah, I know, with absolute certainty that I cannot spend that $10,000 tomorrow to buy a car.
Right, because you've traded your present purchasing power for future purchasing power, usually with a little bit of interest tacked on to compensate you for the wait.
The defining characteristic of the loan is the exchange across time. Present availability is traded for future availability.
You relinquish ownership temporarily, and the borrower gains ownership temporarily. The legal boundary is incredibly clear.
It makes total sense. But the second type of contract, the monetary irregular deposit, operates in a completely different universe.
Completely different, both legally and economically.
The deposit contract is strictly for safekeeping. That is its sole function.
Right.
If I deposit money with a custodian, I am not transferring ownership. I retain absolute, unadulterated ownership of those funds.
And you expect immediate availability of that money at any single moment you choose.
Yeah, the custodian's only job is to guard it and hand it back the millisecond I ask for it.
Which means, legally and historically, a deposit contract of a fungible good like cash requires a continuous 100% reserve ratio.
Meaning they have to keep it all in the vault.
Exactly. The bank, or the custodian, is legally prohibited from spending, lending, or risking the deposited funds.
Why? Because the depositor expects those funds to be sitting there. If the bank lends the money out, they are breaking the fundamental promise of the safekeeping contract.
It's a total breach of trust.
Think of it like a valet parking service or a high-end coat check. If I hand the keys of my car to a valet, I am entering into a safekeeping deposit contract.
Right. You definitely still own the car.
I retain ownership of my car. I expect it to be parked in the lot entirely untouched until I return.
You're not expecting it to be driven around.
No. If I come back 3 hours later and find out the valet has rented my car out to an Uber driver for the evening to make a little side profit, I would be furious.
Oh, absolutely. And the police would literally call it grand theft auto.
Yeah. The valet can't say, hey, don't worry, the guy will be back in 2 hours and I'll give you a cut of the Uber fares.
Because you didn't agree to a loan. You agreed to a deposit.
Exactly. I didn't lend you my car.
That analogy captures the legal reality perfectly. Classical jurists in ancient Rome and later in early medieval Europe viewed the deposit of money the exact same way you view handing over your car keys.
So violating that 100% reserve rule-taking money left in safekeeping and secretly lending it out for profit was what, exactly?
It was explicitly classified as fraud and embezzlement. It was a massive violation of property rights.
But I mean, the temptation for the valet to rent out the cars is massive, especially if the valet realizes something about human behavior.
Right, the statistical reality of the crowd.
Exactly. The bankers realize that not every single depositor walks into the bank on the same day to demand their money back.
Yeah, if you hold gold coins for 1,000 merchants, maybe only 50 of them come in on any given Tuesday to make a withdrawal.
So the rest of the gold is just, sitting there in the dark, gathering dust.
So the merchant bankers got greedy. They started dipping into the vaults, taking the gold that was supposed to be in safekeeping, and quietly lending it out to third parties to collect interest.
And by doing this, they committed the crime of embezzlement, according to classical law.
Yes, but they also did something much more dangerous, which goes back to your opening thought about the glitch in the matrix.
Right.
By secretly lending out deposit money, they created a legal impossibility.
The simultaneous ownership of a single object.
Exactly.
Because if I deposit 1,000 gold coins for safekeeping, I believe I have 1,000 coins ready to spend. I'm operating in the economy under that assumption.
Right. You think you have that purchasing power.
But when the banker takes my coins and lends them to a merchant, that merchant now believes he has 1,000 coins to spend.
Two separate individuals now hold simultaneous, legitimate legal claims to the exact same physical money.
It's wild. The depositor thinks their money is in the vault. The borrower has the fresh money in their pocket.
It's an illusion. It's complete financial smoke and mirrors.
But wait, if this was considered outright fraud by classical Roman jurists, if people were thrown in prison for this, how did it morph into the foundation of modern global finance?
Well, where did De Soto detail how this historical legal breach was normalized through this unholy alliance?
An unholy alliance?
Yeah.
Between who?
Think about the political structure of early Europe. Monarchs, kings, and emperors were constantly cash-strapped.
Because they were fighting endless wars, right?
Wars, building sprawling monuments, expanding their territories. They needed massive amounts of capital.
And taxing the peasantry inevitably leads to revolts. Raising taxes is a highly visible, very unpopular way to fund a war.
Exactly. So governments looked for alternatives. They saw these incredibly wealthy merchant banking families who were generating massive profits through this secret, illicit, fractional reserve lending.
Ah, so the monarchs realized that if they struck a deal with the bankers, they could secure massive, easy loans to fund the state.
It's the ultimate quid pro quo.
The kings say to the bankers, look, we will look the other way. In fact, we will grant you special legal privileges.
We will formally legalize your fractional reserve practice.
We will shield your banking institutions from the traditional legal rules of property rights that apply to every other citizen.
Right. You can legally rent out the coats from the coat check as long as you lend the profits to the crown.
Wow. So this unholy alliance between governments seeking endless, easy financing and bankers seeking massive, risk-free profits, that laid the precise legal foundation for modern fractional reserve banking.
Yeah, it wasn't an organic evolution of the free market at all. It was a state-sanctioned carve-out that legalized a violation of traditional property rights.
That historical context completely shifts how you view the institution on the corner of your street. Because this isn't just medieval trivia.
No, not at all.
This legalized breach is exactly how your checking account operates today. So let's transition from the historical law into the actual modern mechanics.
We need to dissect the magic and the immense danger of fractional reserve banking.
Specifically how it creates money out of thin air, where De Soto uses the Latin phrase ex nihilo.
Right, ex nihilo. And to grasp the magnitude of this creation, we have to look at the multiplier effect.
Okay, let's get into that.
When a legal system abandons the 100% reserve requirement, it replaces it with a fractional reserve requirement. The regulators tell the banks, you only need to keep a small fraction of your depositors' money in the vault.
Let's run the math on this to make it visceral. Let's say you walk into a bank and deposit $1,000 in physical cash. This is a demand deposit. You expect to be able to use your debit card the next day.
Okay, so under a 10% fractional reserve requirement, the bank takes that $1,000, locks $100 in the vault, and immediately lends out the remaining $900 to a borrower.
What's fascinating here is the mathematical paradox we immediately hit. Your checking account still reads $1,000. You can write checks against it, buy groceries.
The banking software tells you the money is there.
Simultaneously, the borrower has a brand new checking account balance of $900, which they immediately begin using to buy things.
Exactly. 1,000 physical dollars just morphed into $1,900 of actual purchasing power circulating in the economy.
The physical cash didn't multiply. No one mined more gold or printed more paper bills. The bank simply created $900 of new purchasing power by typing digits on a screen.
And the cascade is just beginning. When that borrower spends the $900, the person who receives it takes that $900 and deposits it into their own bank.
And that second bank is also operating on a fractional reserve.
Right. They keep 10% $90 and lend out the remaining $810 to another borrower.
The cycle repeats indefinitely. A single initial deposit ripples through the banking system, generating this inverted pyramid of credit.
By the time the math runs its course, that single thousand can create up to $9,000 or $10,000 of newly created electronic balances.
Huerta de Soto refers to these unbacked electronic balances as fiduciary media, right?
Fiduciary media, yes. They function as perfect substitutes for real cash.
Because when you swipe your debit card, the grocery store doesn't care if the digits represent physical vault cash or fiduciary media created through loan expansion. It all spends exactly the same.
Which is a profound distinction from legitimate financial intermediaries.
Wait, how so?
Well, if you buy a corporate bond, or if you put your money into a mutual fund, you are transferring your existing purchasing power to someone else. You can't spend the money, and the corporation can. The total amount of money in the economy stays completely flat.
Oh, I see. But with fractional reserve demand deposits, the bank expands the total quantity of money substitutes without requiring anyone to actually save a single real dollar first.
Exactly. Which exposes the terrifying fragility of the entire global structure, because the total volume of checking deposits wildly exceeds the physical cash actually held in the vaults.
The banking system operates in a perpetual state of insolvency.
Perpetual insolvency.
That's horrifying. The banks are mathematically bankrupt every single day. If even a fraction of depositors decide to ask for their coats back from the coat check at the same time, the attendant has to confess that the coats are gone.
The system collapses in a bank run.
Which naturally leads to a massive question about institutional survival. If the system is mathematically insolvent by design, how does it survive? Why isn't there a banking collapse every other week?
The answer to that is a true origin story of the central bank. And this completely shatters the mainstream narrative.
Because we are taught in history class that central banks like the Federal Reserve or the Bank of England were created as these noble, public-serving institutions designed to protect everyday consumers.
Right, to protect us from the ravages of wildcat banking. But Huerta de Soto dismantles that myth completely.
Central banks were not created to protect consumers.
No, they were created to act as the ultimate lender of last resort, to backstop, protect, and quartilize the fractional reserve banking privilege.
It's an insurance policy for the unholy alliance.
That is exactly what it is.
When private banks expand credit too aggressively and inevitably face a bank run because they don't have the cash, the central bank stands ready with a limitless printing press.
They flood the private banks with emergency liquidity, bailing them out. The central bank institutionalizes the instability.
It removes the free market penalty for operating an insolvent business.
They socialize the risk of the fractional reserve system while allowing the private banks to privatize the immense profits of credit expansion.
So the central bank's primary historical function is to ensure the credit machine never has to face the natural consequences of its own mathematical overextension.
Yes.
Okay, so we have established that banks are essentially creating unbacked credit out of thin air. But to understand why this unbacked credit causes the entire economy to crash, we have to pause our talk about money for a second.
Right, we need to look at how the physical world actually produces goods.
Exactly. We have to look at the physics of capital theory and the structure of production.
This is where Huerta de Soto leans heavily on the giants of the Austrian school figures like Karl Menger, Eugen von Bohnbauwerk, and Friedrich Hayek.
Because in mainstream macroeconomic models, capital is often treated as a homogenous blob, right?
Yeah, a giant undifferentiated pool of money that can be instantly transformed into whatever the economy needs.
But Austrian capital theory forces us to look at time and physical constraints. Capital is not a blob. It is an intricately layered, multi-stage structure that unfolds across time.
Let's use a tangible example from the text to break this down. The loaf of bread.
Okay, let's walk through it.
The final consumer good is the loaf of bread sitting on grocery store shelf, ready to be bought. But reaching that final stage requires a staggered temporal journey through what Austrians call the higher order stages of production.
So to get the bread, you first need wheat.
Right. And to get wheat, you need flour mills to process it. To bake it, you need massive baking ovens.
And to build the ovens, you need steel. To get the steel, you need iron ore from a mine.
Exactly. The mining operations and the steel mills are the highest order stages. They're furthest removed in time from the final consumer good.
Each step requires massive amounts of time, extreme labor, and saved capital. Because the miners digging the iron ore, they need to eat today.
Right. They can't wait 2 years for the bread to be baked to get paid. They must be sustained by a pool of saved capital.
Which brings us to the core constraint of reality. A society cannot embark on massive, time-consuming, higher-order projects unless it has first saved enough real, physical resources to sustain the population while those projects are being completed.
Which raises this ultimate coordination problem. How does an economy know what to build?
Yeah, how do millions of entrepreneurs know whether they should build long-term iron mines or just, bake more bread today? Who sends the signal?
The signal is transmitted through the concept of time preference, which manifests in the free market as the interest rate.
Time preference. Let's dig into that.
Time preference is simply a reflection of how much a society values consuming things right now in the present versus deferring gratification to consume more in the future.
Let's map out the two extremes. Let's look at a society with a high time preference.
Okay, in a high time preference society, consumers want things now. They spend almost all of their income on consumer goods today. They don't save.
And because voluntary savings are incredibly scarce, the pool of loanable funds in the banking system is tiny.
Right, and when supply is tiny, the price skyrockets. So the market interest rate shoots up.
And that high interest rate is not just some annoying cost of doing business. It is a profound communication system.
It screams to the entrepreneurs, don't start long-term projects. We have not saved the resources to sustain you. Capital is scarce.
Focus on producing immediate consumer goods because that is what the public wants right now.
Exactly. The high interest rate protects the economy from embarking on projects it cannot afford to finish.
But let's look at the inverse. A low time preference society. In this scenario, consumers decide to restrain their immediate consumption. They defer gratification and save a significant portion of their income.
As those real savings pool up in the financial system, the supply of loanable funds expands massively.
And this abundance naturally drives the market interest rate down.
Which sends a totally different, incredibly vital signal to the entrepreneurs. It tells them, consumers have stepped back from buying immediate goods. Real physical resources have been freed up.
The society has amassed a massive pool of savings. It is now completely safe and highly profitable to begin long-term, multi-stage projects like factories and tech infrastructure.
The low interest rate gives the green light to build the higher-order capital goods. It acts as the central nervous system of the economy.
So the interest rate isn't just a price for borrowing money. It's a profound communication system between what consumers are saving today and what entrepreneurs are building for tomorrow.
Perfectly stated. And if the interest rate is a vital communication network reflecting physical reality, the most dangerous thing a society could possibly do is tamper with that signal.
Which leads us directly into the centerpiece of the book, the Austrian theory of the business cycle. What happens when fractional reserve banks hack that system and send fake signals?
Here's where it gets really interesting. We enter the boom phase, the illusion.
Walk us through the illusion.
Imagine the central bank decides it wants to stimulate the economy. It lowers its benchmark rates. The commercial banks, operating on their fractional reserve privilege, unleash a torrent of newly created unbacked credit into the loan market.
So central banks and private banks flood the market with unbacked credit. Interest rates drop artificially.
But this is the critical distinction. This drop in interest rates is completely false. Consumers haven't actually saved anything.
Right. They haven't reduced their consumption of immediate goods. No real physical resources have been freed up. But entrepreneurs see the cheap money and assume real resources are available.
They misread the hack signal. Encouraged by the cheap credit, they simultaneously launch massive long-term capital projects, real estate, heavy manufacturing, tech infrastructure.
The economy looks incredibly prosperous, right? This is the boom. Companies go on massive hiring sprees, stock markets soar to record highs.
But beneath the euphoria, Austrian Capital Theory reveals a structural nightmare unfolding. The system is engaging in massive malinvestment.
Malinvestment. I want to clarify that term. It doesn't mean bad in a moral sense, right?
No, not at all. It's structurally misplaced. Capital and labor are sucked into incredibly long-term projects that the economy cannot actually afford to finish.
Because no real physical resources were saved.
Exactly. The banks printed paper money, but they didn't print physical steel or concrete or wheat. The paper money gave the entrepreneurs the financial ability to start the projects, but not the physical resources needed to finish them.
Which brings us to the inevitable turning point. Price inflation.
Yes. As these massive projects move forward, they require constant inputs of raw materials and labor. Entrepreneurs begin bidding aggressively against each other for scarce resources.
But remember, the consumers never actually lowered their time preference. They are still out there trying to buy immediate consumer goods.
So you have a dual-front war for reality.
Right. Entrepreneurs are fighting for scarce raw materials for their new projects, while everyday consumers are fighting for immediate goods. This dual competition causes prices to skyrocket.
Reality catches up. The cost of raw materials and wages surge far beyond the entrepreneur's initial budget projections. The projects become vastly more expensive to maintain.
And the banks look at this surging inflation and panic. They halt the credit expansion and raise rates.
The sudden spike in interest rates, combined with the exhaustion of fresh credit, shatters the illusion overnight. This is the onset of the bust, the crash. The recession.
The malinvestments are violently exposed. Construction sites are abandoned. Tech startups burn through their cash. Millions of workers are laid off.
And this is where Huerta de Soto presents his most counterintuitive point, one that completely upends mainstream financial media.
What is it?
When a recession hits, the government and the media view the recession as a disease that must be fought. But the Austrian framework insists that the recession is not the disease.
It's the cure.
The recession is the agonizing but absolutely necessary cure. The real economic damage, the misdirection of human labor, the squandering of raw materials occurred entirely during the boom.
The boom was the disease where resources were wasted.
Right. The bust is simply the market liquidating bad investments and reallocating labor back to reality. It's the market recognizing what's actually sustainable.
Let's use the analogy from the text to drive this home, because it's brilliant. Mainstream economists trying to fight a recession by printing more money and lowering rates. It's like giving a drunk driver another bottle of whiskey to sober them up.
Yes, that is the exact analogy. The unbacked credit was the alcohol. The boom was the drunken euphoria where the driver thought he was invincible.
And the recession is the crippling hangover.
If you give the drunk driver more whiskey while they're vomiting from the hangover, you will temporarily mask the pain. But you haven't cured the toxicity.
You just postpone the hangover, but guarantee a much worse crash down the road.
Exactly.
So, if the Austrian view is that recessions are necessary market corrections, how did we end up with modern governments doing the exact opposite? Constantly printing money to stop them.
That requires us to examine Huerta de Soto's blistering critique of mainstream economics, specifically the two dominant schools of the 20th century.
Keynesianism and monetarism. Let's start with Keynesianism.
Okay, so Keynesians view the economy through the lens of macro aggregates. They don't look at the intricate, time-staggered structure of production we just talked about. They view the economy as a single, massive, aggregate bucket of demand.
So to a Keynesian, a recession is just a mysterious drop in spending.
Right. They think the water level in the bucket just fell for no reason. So their solution is blunt: government deficits and money printing. Pump more money into the aggregate bucket.
But Huerta de Soto argues this completely ignores the internal, multi-stage structure of capital.
Because pumping money into the aggregate bucket just creates fresh malinvestments. It props up the very sectors that need to be liquidated.
It treats the symptom by suppressing the cure. Okay, but what about Milton Friedman and the Chicago School? The monetarists, they seem better because they fear inflation.
Right. They do fear high inflation, but Huerta de Soto heavily criticizes them too. Monetarists want a perfectly stable overall price level. They want 0 or 2% inflation, matching the money supply to economic growth.
Stable prices? I mean, it sounds incredibly reasonable.
If we connect this to the bigger picture, it's actually highly destructive. Think about a healthy, technologically advancing economy. Things get cheaper to make.
Right, technology makes manufacturing cheaper.
So prices should naturally fall. Deflation, making everyone's wages go further.
But if a central bank is terrified of deflation and forces prices to stay artificially flat during a tech boom,
They are secretly pumping massive amounts of credit into the system to counteract that natural price drop. They suppress the interest rate below its natural market level, which triggers the exact same malinvestment boom we just mapped out.
and this hidden credit expansion under the guise of price stability is exactly what caused the Roaring Twenties, leading to the 1929 crash, right?
Yes, the 1920s saw massive productivity gains. Prices should have fallen. But the Fed pumped credit to keep prices stable, inflating a massive stock and real estate bubble.
And the exact same pattern caused the early 2000s tech and housing boom, leading to 2008. The deflationary tech boom of the internet was masked by cheap credit.
Exactly. The pursuit of artificial price stability during a tech boom guarantees a catastrophic bust.
The mention of 1929-2008 shows this isn't just theory. Let's look at the actual historical case studies Huerta de Soto provides to prove this cycle repeats across centuries.
We have to talk about the Medici Bank in Renaissance Florence.
Let's do it.
They engaged heavily in fractional reserve lending. They accepted gold deposits from merchants, but instead of keeping it in the vaults, they secretly loaned it out
To who?
to European princes fighting war.
Oh, the unholy alliance in action again.
Exactly. It created immense temporary wealth and funded the Renaissance, but they were perpetually illiquid. When political instability hit and borrowers defaulted, the banks suffered massive liquidity panics.
And the fractional reserve system collapsed. But if the Medici story is a slow burn, the story of 18th century France and John Law is like a supernova.
John Law's Mississippi Bubble. It's the purest distillation of this book. Law creates the Banque Generale, and he issues paper notes backed by only a tiny fraction of gold.
And he uses this unbacked paper money to inflate the stock of his Mississippi company.
Right. The boom was intoxicating. Peasants became vastly wealthy on paper overnight. The term millionaire was literally coined during this exact manic period in Paris.
But because it was backed by no real savings and the Mississippi company wasn't actually producing wealth, confidence broke.
Investors tried to cash out their paper notes for gold, and the bank couldn't pay. The fractional system collapsed in a stampede, and the French economy was left in absolute ruin.
And you can draw a through line from that to the panics of 1825, 1847, 1929, and modern currency crises.
The through line is undeniable. Central banks do not prevent instability. The historical record proves they institutionalize and amplify it globally by orchestrating low interest rates and credit expansion.
So what does this all mean? If fractional reserve banking and central banks are the root of the problem, how do we fix it? Tinkering with regulations clearly won't work. We need to look at Huerta de Soto's radical blueprint for reform.
He lays out 3 absolute pillars for permanent monetary reform. And the first one is the complete reestablishment of traditional property rights.
Meaning a 100% reserve requirement?
Exactly. Banks must hold 100% cash reserves for every single dollar in checking or demand deposits.
So the valet parking analogy becomes reality again. The money is literally locked in the vault untouched.
Bank runs become physically and mathematically impossible. Panic vanishes from the banking sector. Banks just charge a transparent fee for vault security and payment clearing.
Okay, I have to play devil's advocate here. Wait, if banks have to keep 100% of my checking account in the vault, how does anyone get a mortgage or a business loan? Does lending just die?
That is the most common objection, and it's a total misunderstanding. Loan banking remains completely legal and vital, but it is decoupled from demand deposits.
So how does a bank fund a loan?
Banks issue equity shares or long-term time deposits, like a 5-year CD. Savers voluntarily surrender the availability of their money for a fixed time.
Ah, the bank lends out real physical savings.
Exactly. 2 people never have the right to the same money at the same time. The dual ownership paradox is solved.
Which brings us to pillars 2 and 3. Abolish central banks and privatize money.
Right, because with 100% reserves, solvent banks can't fail. So central banks become completely obsolete.
We eliminate the government's ability to manipulate interest rates entirely.
And Huerta de Soto advocates returning to a 100% market-chosen commodity standard, historically gold, So money grows predictably alongside real production, entirely free from political decrees.
Look, this sounds incredible in theory, but practically, transitioning an economy with trillions of unbacked dollars into a 100% reserve system, it would instantly bankrupt the globe. How do we get there?
It requires a very specific four-step transition strategy to prevent a crash.
Walk us through it.
Steps 1 and 2. The central bank mandates a future date for 100% reserves. To prevent bankruptcy, the central bank prints a one-time massive administrative balance sheet entry.
They print money.
Basically, yes.
Yeah.
They give these new reserves to commercial banks to back existing checking accounts dollar for dollar.
But wait, doesn't printing trillions of dollars trigger massive hyperinflation?
No, and this is the crucial detail. These new reserves are locked permanently in the bank vaults to back the existing deposits.
Oh, they cannot be spent in the real economy.
Exactly. They simply plug the hole in the balance sheet. They convert empty fiduciary media into fully backed cash deposits. The money never leaks out to bid up prices.
That's brilliant. And steps 3 and 4?
Once fully backed, commercial bank money creation is permanently frozen. The central bank is dismantled, and the currency is fixed to a weight of gold forever.
It's a staggering blueprint. But beyond the mechanics, this raises an important question about the deep moral consequences of our current system. Who actually benefits right now?
We have to talk about the Cantillon effect.
Let's explain that, because this is where it gets highly unethical.
When fresh money is printed out of thin air, it doesn't distribute evenly to everyone at the same time. Large banks, government contractors, and financial elites get it first.
And they get to spend it before prices rise.
Exactly. They buy up hard assets at yesterday's lower prices. But as that new money trickles down to the shallow end of the pool, to wage earners and retirees, inflation has already driven up the cost of living.
So it is a quiet, systematic redistribution of wealth from the working class to the connected elite.
It is a hidden tax that widens the wealth gap perpetually, and it causes deep social decay.
Because artificial credit forces ordinary citizens to become financial gamblers. You have to risk your life savings in volatile stock markets just to outpace inflation.
Whereas sound money fosters long-term thinking, social stability, and it actually rewards personal responsibility.
We have taken a massive journey today, from the ancient Roman laws of deposit contracts through the dangerous magic of fractional reserve banking into the deep physics of how capital is formed.
And we finally understand why booms must inevitably lead to busts as long as unbacked credit exists.
Understanding these mechanics allows you, the listener, to see past the financial media hype. You can identify economic bubbles before they burst and understand that real prosperity comes from hard work, innovation, and voluntary savings, not a printing press. I want to leave you with a final thought to mull over, building on the concepts of natural deflation and the Cantillon effect. Imagine a world operating on Huerta de Soto's 100% reserve system, where technology constantly makes goods cheaper and your money gains purchasing power every single year just sitting in a vault.
Just passively gaining value.
Exactly. How would that fundamental shift alter the psychological trajectory of your entire life? If you didn't have to constantly hustle and gamble in the stock market just to survive inflation, would the anxiety of the modern rat race even exist? Thank you so much for joining us on this deep dive. Keep questioning the headlines, keep exploring the deep mechanics of the world around you, and we'll see you on the next one.